Hello and welcome to the Canaccord Coffee Break podcast. This is our last regular weekly podcast of 2025. How quickly we've come to the end of the year. And as usual, I'm delighted to be joined by Tom Hibbert from our Chief Investment Office, and also delighted to let everybody know that Tom is now our Chief Investment Strategist. So congratulations.
Thank you, Jane. Yeah, that's great.
Well, welcome. I'm sure it's all to do with the podcast
I'm
that's elevated
sure,
you. Anyway, welcome to our bite-sized market insight, hopefully in just under 10 minutes. And if you like what you're hearing, please don't forget to hit follow on Spotify or Apple and you will never miss an episode. So grab your coffee and listen in, and let's get into what's been happening in the last week or so in the markets. And it feels, Tom, like the end of the year has followed pretty much the same theme of all of 2025, and maybe we are ending the year with more questions than answers, but hopefully you can give us some answers today.
We'll see. Yeah, don't know about that.
So the US equities briefly reached new highs following the Federal Reserve, the Fed's latest interest rate cut.
Yeah.
But those gains faded away with renewed scrutiny on tech valuations, which weighed heavily on sentiment. And that's something we've been talking about over the last few months, really. And last week, we also talked about the possibility of a Santa rally, but his sleigh does seem to have got stuck, drifting sideways in a bit of a snowdrift this week. So perhaps, Tom, you can give us a brief summary what's been going on in the last week or so.
Okay. And I suppose there hasn't been a clear trend in equity markets. And the main reason for that is this week is a very busy week of central bank meetings. We've got the Bank of England, we've got the Bank of Japan, but also we've got a load of key economic data, labour market data, inflation data in the US, which, because we've had a government shutdown, we haven't had any official data for a few months. And now we're getting a whole load of data for the last few months. So it's a key week where I think investors are looking for that data first, and there hasn't been a clear trend ahead of that data. So last week, no clear trend, but a little bit of weakness in the tech sector and some of the AI names, but broadly still positive sentiment and good performance from other sectors, other cyclical sectors, financials, industrials, materials, all performing quite well. So
no wind down in the run up to Christmas then. But the Fed did give us a little Christmas present by way of a rate cut. But I think you said in this week's Weekly Markets Review that there was a more significant announcement in that quantitative tightening will formally conclude. I just wanted to get into that a little bit more and understand what that really means. I know we were all really familiar with quantitative easing in the past, and that was part of our vocabulary for a long time. But perhaps you could just tell us what's the difference between quantitative tightening and quantitative easing, and then perhaps go on to what's happening now with the Fed.
A very simplistic analogy would be the Fed is a bit like the drive of the car, which is the US economy, and they can press their foot on, they have some tools to press their foot on the accelerator, and they have some tools to press their foot on the brake. When they're doing QE, which they did in largely after the global financial crisis for a long time, and during the COVID pandemic, they have their foot on the accelerator. So QE that's quantitative easing. And that is when they buy bonds and replace them with liquid cash. So they're injecting cash into the financial system. Quantitative tightening is when they've got their foot on the brake. And they've had their foot on the brakes during the recent inflation spike that we've had. So they've been doing quantitative tightening. They have,
which means they are selling.
They're selling the bonds back into the market that they previously bought during QE, and actually the bonds mature naturally, so they're just sort of rolling off their balance sheet.
And that's the foot on the brake.
That's the foot on the brake. So now what they've announced is they can't actually really take their foot off the brake fully because the bonds are maturing naturally. So they have to put their foot on the accelerator at sort of the same rate. So what they're doing now in this new neutral regime is they're putting their foot on the accelerator to the same degree that their foot is on the brake, if that makes sense.
Dancing on the pedals.
And they're doing it timing now slightly for technical reasons as well. So they're providing some liquidity to ease some light stresses in the short term funding market. So that's just another reason why they're doing it now. But at the margins, well, actually not even at the margins, it should provide some good support for markets in the short term.
The other interesting thing I think that came out last week was the US administration's national security strategy, which I think they released on Thursday.
Yeah.
Do you want to just touch on that and how that is going to impact the markets and what our clients and investors should be thinking?
Yeah, absolutely. And I mean, I'm someone who reads these things, and this one was a better one to read than previous ones because it was much shorter.
Oh, good.
And it didn't seem to just tie in every single sort of current event. It was quite concise and quite targeted. You also need to be a bit careful with these things because you need to make sure that you're not being political and you're focusing on the economic impact.
Yeah.
And actually with this one, it's very easy because it's so clear, it comes across so clearly how the national security strategy is so centered on the US economy and their economic strategy.
Go on.
So what stands out is how explicitly economics, productivity, and technology are framed as central pillars of national security.
Okay.
So technology leadership, particularly in AI and quantum computing, interestingly.
Yeah.
Advanced manufacturing and domestic advanced manufacturing
In the US.
In the US, exactly. Central to national security strategy, but not merely a race between companies, but also a race between the great powers, between China and the US. So they're on this race to general intelligence too. And it shows how the administration sees economic strength as the foundation of national power.
Yeah.
And it explains why the US government is so keen to keep the fiscal taps open, to keep this cycle pumping, to keep the AI growth race driving economic growth and productivity. So it has vast implications for the economy, and it was just an unusually interesting document, and it sort of reflects, I suppose, the end of this era of globalization in a way.
Okay,
We're now in a multipolar world with great powers who have their spheres of influence, and the US is it's very aware of that, and I think that comes across very strongly in the document.
Interesting. Well, thank you very much for your time. And let me just have a quick look what's in my takeaway coffee cup today. So while cutting interest rates, the Fed has given us a little bit of a Christmas present, but has resulted in Santa drifting slightly sideways in a snowdrift this week, rather than any sort of Santa rally for the end of the year.
Yeah.
We've talked about how the strategic arms race between the powers, most notably the US and China, is significantly impacting economic policy, fiscal policy, productivity, technology, which are framed as central pillars of the US national security strategy, and how that might be used productively to create technology leadership, particularly in AI, in quantum computing, and in advanced manufacturing. So interesting times.
Absolutely.
That whole quantum computing aspect, really interesting. And actually, I've got a Christmas special podcast with John Polistracki, your colleague from the Chief Investment Office, talking a bit more about that.
That'll be interesting.
He slightly blew my mind, if I'm entirely honest, Tom, but looking forward to getting that one out. And also, we've got another Christmas special about why a dog is for life, not just for Christmas. Also with John, looking at innovative pet diagnostics. And I would just say, investing isn't just for Christmas. That's for all year round as well. So I do hope you've enjoyed the first few months of our podcast. Our regular weekly podcast will be back in the new year, probably week beginning the 12th of January. So
thank you for listening, everyone.
And happy Christmas, and here's to a prosperous 2026.
Investment involves risk. The value of investments and the income from them can go down as well as up, and you may not get back the original amount invested. Past performance is not a reliable indicator of future performance. The information provided is not to be treated as specific advice. It has no regard for the specific investment objectives, financial situation, or needs of any specific person or entity. It is accurate at the time of recording and is subject to change.